Hi, everyone. My name is Dustin Miles with Momentum Multifamily. I'm excited to have Andrew Davis here today. I've been following him, like I'd mentioned, Andrew, on LinkedIn here for a little bit, and definitely has lots of interesting things to say and some great insights. So appreciate you coming on, and would love to just learn more about you. So, yeah, if you wouldn't kind of just a little bit about your background, and we'll dive in from there.
Yeah, absolutely. No, thank you so much for having me, and I really appreciate the time. And yeah, my name's Andrew Davis. I live in Asheville, North Carolina, with my wife and twin toddler boys.
Oh, cool.
So that's a little bit about me personally. Have always been fascinated with investing. Just a little bit about my backstory and how I got to where I am today. I've always fascinated with investing. My uncle was a stockbroker, and so I think when I was in the second or third grade, I would go like onto his trading floor, and just always interested in business. Had two entrepreneurial or self-employed parents, and I was
Hmm.
buying shares of Microsoft back in the early 90s as a kid in elementary school, waiting for the morning paper to see the updated stock price.
Oh, wow.
And yeah, it was just really just I've always been a serial entrepreneur, and kind of got away from it for a little while. I sort of stumbled my way into corporate America via a college job and did very well in sales, but um, honestly, just didn't enjoy it. I didn't enjoy working for other people. I've always been a big efficiency person, and so I don't like to do things just to do them. I like to do things because they're valuable and effective, and so that never really served me super well in corporate America because there's a lot of just do what you're told, and that really to a degree was my catalyst for moving into investing in real estate investing. And I didn't really know that real estate investing was a thing until I was in my early 20s, and
Hmm.
I by chance picked up a Robert Kiyosaki book on vacation,
Wow.
and it just planted the seed that was like my real estate investing awakening, and just understanding assets and liabilities, and making money work for you in that way, and just all the different leverage points that real estate has. And I, as I do when I'm interested in something, I dove in, read everything I could, talked to everybody I knew, and not too long after that, I started raising money for real estate. And
Wow.
I raised money for my first deal. It was a flip, and I raised all the money for the purchase and partnered with a GC on the rehab. And it turns out I was actually really bad at like flipping houses and building a single family portfolio. I had some
Yeah.
successes, some kind of break evens, a couple losses. But
Yeah.
what I really found throughout that process is I think building a single family portfolio is a very inefficient way to build wealth in real estate, at least at scale. It was for me with my particular disposition and skill set.
Yeah.
And I also discovered that I really, really enjoyed building relationships with people. I liked finding deals, and I was good at raising capital. I could quickly articulate a value proposition. I was confident in what I was doing. I just naturally built trust and rapport, and that ultimately led me into private equity and commercial real estate. And so I helped build what was a small CRE, private equity CRE firm based out of South Carolina. They had prior to my starting, they were raising their best year had been just shy of 50 million raised, and in my first year, just full time hammering the phones, raising capital, brought in just shy of 200 million.
Wow.
And that was like, oh yeah, this is my sweet spot. There's a lot that I'm not good at, but this is what I'm good at. And then was given some tremendous opportunities there to really get exposure to all sides of the business. So
Hmm.
got to build an IR team. I got to do a lot with like marketing strategy and speaking, podcasts, webinars, communications. Got to be on the deal review committee. I got to start building out like an institutional family office channel, and so got a little burnt out, to be honest, but it was a really valuable experience because I really got to see the inner workings of how a private equity or syndication business works. And then in year two, which was 2022, my
Hmm.
team and I raised just shy of $300 million.
Wow.
Um, And that was an incredible experience for me. And went to go work after that for another firm called DLP Capital, based out of Florida primarily, although they have several offices. Workforce housing operator, great experience. Learned a ton there,
Mm.
and pretty early on in my tenure there, I just got the seed of the idea, which has become my current business, Equity Check, and I started that in July. So
Wow.
I imagine we'll dig into that a little bit more as we chat, but that's my background.
Yeah, that's
Yeah.
awesome. Yeah, that's great. I not sure how much you're, pound the phones these days, or if that's still something you do a lot of, or if someone else does it for you. But what does, what's working? A lot of people, oh man, raising capital is hard, and there is, I think some truth to that. I think
Sure.
there's look, it's pretty easy to raise capital when when a lot of us have had all these wins, the past, basically, 2012, 2019, and then, also in 21, some people, if you sold, you did very, very well, usually around that time. And so it was easy to point to like, hey, we just doubled, tripled everybody's money within a few years, and
Yeah.
so a lot of people were a lot of liquidity moving around, and so they're like, oh, I'm rolling, I made 200K, I'm gonna roll, that, and I have some extra money into this deal. And so what does capital raising look like now, for you guys? Have you had to change your approach much? What does the world look like today there?
Yeah, it's a great question and a great point. And I think a couple things. Just like capital markets and economic cycles are cyclical, capital raising cycles are cyclical as well. And so, yeah, I mean, the years that I was raising capital, those were very, very good years
Yep. Yep.
to be doing that. Not the years that I was raising capital, the years that I raised that amount of capital. Very,
Yeah.
very good years to be doing that. And one of the things that I've really, really appreciated being in this space, I've always really valued talking to people that are smarter and wiser than I am, and have had
Hmm.
just the benefit of being long in the tooth, right? They've been in the trenches for a very long time. They've
Hmm.
been through multiple cycles. They've seen great years, challenging years, and they have just a more long term perspective, and the kind of the I don't know, call it the encouragement. And I can talk a little bit about tactics and strategy, but
Hmm.
is that really, I think the best thing you can do as a capital raiser, or an aspiring capital raiser, is elongate whatever your time horizon is. And so
Mm.
we would do these, like, host these masterminds back at my first PE firm, and people would say, they'd come in and they were like pretty new to the game, and they'd be like, well, how do we
Yeah.
raise $200 million? And I'm like, I think you're asking the wrong question. It's
Yeah.
how do you build an enduring business, and how do you deliver value over the long term to your investors in
Hmm.
such a way that that will be the ultimate outcome, but it's a byproduct of what you create. And one of our operating partners is a group called Ventura Living.
Hmm.
um, they're a top 10 multifamily operator in the US. They have just shy of 6 billion AUM. They've been in business
Wow.
for 23 years. They consistently raise, on average, 200 to 300 million a year.
Wow.
But in the last couple of years, they haven't raised that much because they sat on the sidelines. We just wrapped up a raise for them with a deal in Bentonville, Arkansas. They had been studying, underwriting, and making offers on assets in that market for 7 years before they found a
Wow.
deal that they were
Wow.
that they were willing to move forward on. And so I think a lot of people are afraid that if they're not doing deals, if they're not actively raising capital, that they're going to become irrelevant. And that's not true. What
Yep.
Ventura does very, very well is they're consistently talking about their methodology and their thesis, and why they're doing deals or why they're not doing deals. And they have an incredibly data driven approach to that. And it creates a lot of trust with their investors. And before I ever started raising capital for them, as part of my DD process, I interviewed some of their investors. One of the guys I spoke to has invested $400 million with them. every deal
Wow.
he's putting in eight figures because there's so much trust. And
Wow.
so, what I would
Wow.
encourage anybody that wants to raise capital is like, hey, you want to be in this 10, 20 years from now. And that was the other thing that I loved about working with. One of the first things that really struck me in talking to these guys is they said, hey, we're building a business that's going to be profitable like 50 years after we're dead. So they're really thinking
Wow.
long, long, long term.
Yeah.
And that just comes across in everything that they do. And that just generally that just inherently creates that trust with their investor base. And so, in a time that people are struggling to raise capital, they raised on our last deal. We had a nice allocation in it, but the overall raise for a two pack deal that closed in March. No, I guess just, yeah, at the end of March, it was $100 million, and they raised it in 45 days. So when people say
Wow.
capital raising's hard, yeah, capital raising's hard, but it gets easier over time as long as you're doing the right things.
Yeah, yeah, that's awesome. Yeah,
Yeah.
one thing that sorry to cut you off there, but
No, please.
just Gary, I don't know if you pay attention to Gary Vaynerchuk or not, but
Hmm.
I know that's one thing that he's always talked about how people aren't thinking, you know, how if you end up working with this person for the rest of your life, I mean you're going to treat them a lot differently than if it's just going to be a quick flip or something like that. And so he
That's it.
point being think everybody needs to be thinking a lot longer. And it's funny, just and I also think that a lot of newer investors that kind of got in, and I started in 2012, but kind of the people such as myself, that started around then, we got really spoiled.
Hmm.
We had, cap rates were, I bought my first deal at a 10 cap, and then, I sold, I think, at a 7 cap or so. And so, I mean, have this, cap rate going down. You have rental rates were going up. I mean,
Yeah.
we were bumping rents. This is C class deal. We were bumping rents, probably every 6 months, for 5 to 10%. I mean, it was crazy. And that's
Yeah.
obviously not sustainable whatsoever. So I really think that you mentioned it, and I've seen talked to we think the same thing too. Like I think the horizon, instead of a lot of people, hey, we're going to be in this for 3 years, we're at least five, potentially even a little bit longer. And I think if you kind of give real estate a little longer horizon, because 2 or 3 years, unless it's like a really deep value add, is not very realistic in terms of an attractive return. But
Yeah.
I think people give a little better horizon or a little longer horizon. I think real estate just be just fine. So
Yeah, totally agree. And then, like, I mean, yeah, that to what Gary Vee said, one of my favorite very quotable people is Naval Ravikant. And he says you want to play long-term games with long-term people. And
yeah.
that was actually like my co-founder and I in our very first conversation, we both like kind of quoted that at the same time. And it was
Oh, that's
it,
cool.
it was like, did we just become best friends, like stepbrothers? um
Instantly.
and yeah, exactly. So no, I
Yeah,
think that's
that's
when
cool.
when that's your approach, people pick up on that. And
Yeah.
it's in everybody's best interest to approach life, business, relationships,
Yep.
real estate like that.
Yep. Yep.
Yeah.
Yep. Yeah. Yeah. And we treat, I mean, that's how I'm sure that's why you've been able to raise as much as you guys have.
Yeah.
You treat people like, I'm going to be working with you forever, or, for the rest of our lives. And,
Yeah.
I think if, especially, I've partnered up with, we have different partners and all that. And, we treat people, how obviously how we'd want to be treated, but we're treating them, as if we're going to be working together for, the next 30, 40, whatever ends up, hopefully lifespan a little, is, attractive there. But,
Yeah.
just, it's a long, long, long term, relationship in general. So,
Absolutely.
yeah.
Absolutely. Couldn't agree more.
Yeah. In terms of very, I've heard, I've seen Ventana, that's how it's pronounced, correct?
Ventura.
Venterra. Okay.
Yeah.
Yeah, I've seen them around. I think they own a deal or two by close by some other deals that we have. In terms of maybe some of the tactics and all that, the for your more recent raise, have you guys,
Mhm.
you know, from 21, 22 to now, has any of that really changed for you guys for your raises, or you know, or is it, you know, more of a personal touch now versus, you know, probably 21, 22, you might have been able just to do a webinar or send out an email and then you know, you're instantly getting wires. What does that process look like for you guys?
Yeah, it's a great question, and it's been, I mean, to a degree, right? It's going from two large companies that had seven-figure plus marketing budgets and a real machine in place to, certainly not starting from scratch, but starting with a much smaller network and very intentionally building. And
Mm,
so by design, it's been those much more relational touches. And what I've really enjoyed about that is number one, especially when you have what I think of as like second generation LPs, and those
right.
are people I think that invested in this last market cycle where it's like, even if the operator was terrible and it wasn't that great of a deal, just by function, like you said, of unprecedented rent growth driven by multiple factors and compressing cap rates, even
Yep.
bad deals were good. And so
Yeah.
you had a lot of people that did well. In I don't know that we'll see a market cycle like that again. Who
Right.
knows? I hope we do, and and that'd be great. But I don't know that we will. And so, what I'm talking to, and most of the people I have relationships with, they are not brand new to this arena. They've
Hmm.
been burned. They've experienced capital calls, paused distributions, subpar communications from their sponsors, and
Mm,
so they're really, they've been a bit, disillusioned, and and
yeah.
and so it's really having the conversation, understanding what their very legitimate concerns are, and then really not only articulating, hey, this is what we're doing differently, because I'm one of those people. I've gotten
Hmm.
I've gotten in those deals that, like, they
Hmm.
look great. The thesis made sense to me, the market made sense to me, the business plan made sense to me, and they're not performing the way that I want them to. And so, yeah, it's a much more relational touch. But what I like about that is not only, do I get to do that relationship building and growth, which is my favorite part about this business, but I
Yep.
also get to, from those conversations, those inform, what we put out on LinkedIn. Those inform how we structure our communications. Those inform,
Yep.
how we're building pitch decks and presenting deals, et cetera, understanding what's really, really important to our end investors. So, for me personally, if you're talking about, like, we have a VP of sales, we have a couple guys that just really work, setting appointments, and just kind of on the sales ops side. But I never want to get away from talking to investors because
Right.
I enjoy it. I think I'm good at it, and that's who we're serving. And so if I lose touch with that, then I think that's not good for the business.
Yeah, well, and
Yeah.
it's not like you're selling them some $10 widget. I mean, they're probably
Right.
putting in at least 50, 100K, if not more.
Correct.
And
Yeah,
so, I mean, that's, you know, I don't know. I mean, it's a lot of money.
it
So,
is.
and some people, it may not be a lot of money to them, but I mean, still like 100 grand's 100 grand. So,
No, it absolutely. Well,
uh,
and whatever it is, whatever it is, whether it's 50,000 or 500,000 or 5 million, it's
yeah,
a lot of money. And I think
yeah,
that's the thing that I really try to drive into my team. And because when we're in this world, you start talking about hundreds of millions, and you just
yeah,
use these
big
big numbers all
numbers.
the time. And
Hmm.
then you talk to a $50,000 investor, and it can be easy to go, oh, it's only $50,000. That I didn't My first salary was like $36,000 a year. I mean, the
Yeah,
fact that you would say
yeah.
only 50, that's a tremendous
It's
amount of
crazy.
money. Yeah, so I think it's
Yeah.
really, really important to remember that that's representative of somebody's, like, time, energy,
Yep.
blood, sweat, and tears, discipline and savings, whatever, and to really, like,
Yeah.
whether, and the well, and an interesting story too, that I shared with you Ventura, they've got these really, really big check writers.
Hmm.
Their minimum is their average is well over 1 million. Their minimum is I think it's 250 now. And they had somebody come in on one of their this deal for like 50K, and they were kind of like, okay, we'll take it. Well, that was the guy that ended up investing has invested hundreds of millions with them. And he just wanted to see how they communicated. He just
Yeah.
wanted to,
Wow.
it was just a little feeler. So you never know who you're talking to.
Right.
And
Yeah.
if you purely judge people by what they're considering investing in your first deal, you're missing the point.
Yeah, that's awesome. That's really
Yeah,
cool. Yeah, well, in the point, I mean that guy 50K probably is not a whole lot, but 50K to some people, I mean that might be, I mean that's a ton. And to your
it's a
point, I
ton.
mean I mean my first job was, you know, 42 whatever. I mean it was, I mean that you're respecting, their time, like you said, the blood, sweat, and tears they've put into it. I mean it's it's a lot of money. So
It is.
yeah, but that's a very interesting little nugget there that he, 50K, but he ended up, investing a ton of money. So that's fine.
Yeah.
That's cool. Um, in terms of the just so you have, so the landscape, and I agree. I think, always talking to investors, and because we've talked to, a lot of our investors similarly. They've had some capital calls. They've, had some just not go very well. Sometimes a complete equity loss in some instances, and but then we've had, some longtime investors, also, same types of folks that they're holding on to cat. They have some money and they could invest, but he's like, I don't know if I'm gonna have more capital calls, and and what
Yeah.
that looks like. And so a lot of, like, the last raise we did, we saw a lot more of the folks investing were newer, and hadn't had, some of those capital calls, and hadn't had some of those experiences that, are obviously not so pleasant. So are you guys kind of seeing a similar, or are you, seeing a lot of newer investors come in, or a lot of your older investors still put money out as well, or what does that look like?
Yeah, no, great question. It's a real mix, and I think, to a degree, that's just kind of our different marketing strategy and channels.
Yep.
And yeah, I mean, there's always reasons that people are sitting on the sidelines, and I think you really have to be, one of the things that I just have no interest in doing is like hard selling people. And
Yeah.
so recently
Yeah.
it's been, hey, I'm waiting to see what happens with tariffs or interest rates or what's happening with the election or whatever it is. And that's all, I mean, they may believe that, but at the
Yep.
core, that's fear.
Yep.
That's fear, and there's just a lack of confidence there. And it's not a lack of confidence in me or our strategy or our operating partners. I think it's a lack of confidence in their own judgment that can be driven by any number of factors. And so, I think the best investment decisions, a story comes to mind of a lovely young couple that I met, spent a lot of time with, very successful, had a pretty significant amount of capital to deploy,
Hmm.
and they had made a soft commit for, I think it was like 400,000 and change,
Oh wow.
and got all the way through, signed docs and everything, and then they just went dark, and
Wow.
reached out a couple times, didn't hear from them, and finally got in touch with the husband, and it just he blamed it on his wife, which may or may not have been true. It doesn't
Yeah.
really matter. But the
Yeah.
point being is that they were spooked or scared, and the reality for them is that even that investment would have performed very, very well. This was 2+ years ago now. They probably
Yep.
would have, they'd probably be sitting at 1.5x on that investment at this point. But it
Hmm.
wouldn't matter because they weren't there wasn't a confidence there, and so
Right.
that would have been a terrible experience for them, and it would have been terrible experience for me because they would have been calling me all the time, freaking out about every little wave in the economy and et
Yep.
cetera. So
Yep.
yeah, so it's definitely a mix. I mean, I think right now you have a lot of um, I mean, I just saw this. There's like some ridiculous number of trillions that people have sitting in home equity right now. So a lot
Mm.
of people are trying to figure out how to. I know a lot of people that are leveraging home equity to consider investing or make business
Yep.
acquisitions, whatever it may be. And the reality is like a lot of people don't trust the stock market, and so it's not
Yeah.
as if there's a better alternative. Single family investing is, if you're investing for cash flow, it's I'm not saying it's impossible. It's very, very challenging right now because rent growth
Right.
has not even come close to pacing with appreciation and single family home price growth. So that, I mean, that's where I started. I can't in my market, I couldn't make anything cash flow.
Right. Yep.
So there's just a lot of the kind of the active ownership strategies
Hmm.
have dried up in that sense. You can still play the appreciation game, but there's not a cash flow game. So I think at the end of the day, quality investments with sponsors of character and competence are still the best investment that you can make. I firmly believe that.
Right.
Other than investing in yourself, starting a business or something like that.
Yeah.
But yeah, I mean, I think it really is just being with people where they're at, and operating with empathy and curiosity, and then just continuing to stick to your principles. And my experience has been that it may be a month later, it may be a year later. A lot of times people come back, and when
Yep.
they're ready to invest, and they're ready to take that quote risk. So I don't know if that answers your question, but that's kind of
Yeah.
what we're seeing and how we approach it.
Yeah, yeah,
Yeah,
absolutely. Yeah, and to your point about we talked about earlier, long-term game and all that too, and then to your point about the investor might come back at some point. I've had some, started in 2012, and we have had people on my list for, 10 years ish, and they've quietly been, I guess, following, and it's someone I'd met at some meetup and all that. And
yeah,
anyways, they finally invested after about 10 years, and they're like, "Hey, I
yeah,
was, flipped some houses," and I was like, "I've been watching you." And so, and then I had another couple that I met them a few times at like a meetup and all that, and we were friends on Facebook, and so I think that's how they were kind of consuming content from me and all that, and they just out of the blue they're like, "Oh, hey, we had Spy, we wanted to put in 150K, so here," and I was like, "Oh, okay." Didn't I hadn't honestly, talked to them in quite a while, and I went back and
yeah.
looked, and I'm like, oh, we have emails from 2014, 2015, so it's just kind of funny, how all that works. But um, I know I don't want to hog up all your time and all that, but for as far as equity check, what are you guys? I know, in our conversations before, you guys are very, very selective, and who you're working with. The that one group, Venterra, that you'd mentioned, has been, has a pretty long operating history.
Yeah.
What are just, just kind of a few highlight bullet points that you guys are kind of looking for in terms of what groups you work with?
Yeah, yeah, great question. So yeah, this was really this framework was really, really born out of everything that we talked about, right? Just talking to a lot of investors that had subpar experiences. And I know you've had a ton of investor conversations. I have as well. And I think at the core of every one of those conversations, somebody's, it's just a massive, I talk about trust all the time, but there's really, maybe other than like letting somebody watch your children, I don't think there's a higher trust than handing over a significant amount of your capital to somebody else,
Right.
because it's not just money. It represents your future, it represents your security. It's representative of your life energy.
Yep.
And so really what people are asking, whether they're asking about track record or promotes or hurdles or whatever it is, what they're asking is, can I trust you? Do you have
Right.
character? And do you know what you're doing? Are you competent? And so it's like, okay, well, how do somebody can ask me those questions directly, or you those questions directly, and we'd say, yeah, yeah, absolutely, I do. But how
Yeah.
do you really demonstrate that in a reliable way? And so our framework is very simple. It's just three things. The first one is alignment of interests. And
Mm.
so, very simply, the question that we ask before we ever go any further in the DD process with a sponsor is, who wins first? Does the sponsor win first, or does the investor win first? And what we've seen in this space is a lot of sponsors and syndicators that front load fees. And so they get a big win or windfall before the investor ever gets their capital back, let alone getting a good return on their money. And whether or not that sponsor or syndicator is smart or competent or whatever it is beyond the point. You have a
Yep.
fundamental misalignment of incentives, also known as moral hazard, which was the cause of the great financial crisis. I mean, different
Yeah.
circumstances, but same economics. And so, if a sponsor is getting a seven-figure windfall before their investor ever gets their capital back, that to us is the deal breaker, because it just means
Right.
they're going to be incentivized to do deals and not be conservative. So conservative is probably the most overused word in this space right now. Um, the way
Yeah.
that you the way that you the way that you get a high degree of certainty for conservative underwriting is that the sponsor is not really going to make meaningful capital until the investor gets a good return on their money. And back to Venterra, one of the things that I really appreciate about them is they're obsessed with not losing money because they've structured all their deals in that way. They just walked away from a deal that they had $1.5 million hard EMD on
Wow.
because the seller was misrepresenting the financials. And as they got deep into the DD, they saw this, they went back to the seller and said, "Hey, we know that what you're telling us is not accurate. It fundamentally changes the basis and the value of the property. And if you don't, reduce the price by X, we're walking." Seller said, "Go ahead and walk." And they personally took a $1.5 million hit rather than do a deal that they didn't have a high degree of confidence in, because all they have
Wow.
one fee, and it's a 1% acquisition fee, 7% pref, and a 75-25 split. And so they can't lose money. Like, they just won't do it because
Right.
they won't do bad deals because it's costly to them. So that's the
Right.
first thing we
Right.
look for. Once they jump that hurdle, then we look to asymmetry. And really what we're looking for there, obviously, asymmetry is just that, like, low risk, high reward opportunity. And what we look for there is somebody that's got a very clear circle of competence. They're honed in and focused in one area, and they have in one area, they have a depth of experience that gives them a significant competitive advantage versus other players in the space. And so if they don't have that, if they don't have a significant track record, then it just creates risk. They're going to pay more for assets. There's going to be, they're going to have all the learning curve that everybody else does when they're operating a new business, and
Yep.
it creates risk. So that's number two. And then the last one is accountability. As we know, there's no enforced reporting requirements in the private
Yep.
investing landscape, and so investors are at the mercy of how much and how often the sponsor wants to communicate. And so we look for people that are detailed, clear, consistent, and very, very responsive, and that they
Mm.
submit to third-party annual audits. And when they check all those boxes, then we go through a really, a deep DD process where we look at their thesis, we interview their investors, we do background checks, we lawsuits, we do a ton of work, and then we also see, like, just kind of from a macro perspective, is this a strategy that we believe in as well, and is it complementary
Right.
to the other offerings and sponsors that we're representing? So that's our process in short, and it's yielded good results of our operating partners, well over 100 full cycle deals, average experience up 20 years plus, and the metric that we're most proud of is $0 in investor capital lost ever.
Wow.
So
Awesome.
yeah,
That's
that's it.
great.
Yeah,
Um, and then I don't want to be respectful of your time.
yeah,
But the if you wanted to kind of give a few highlights on your agency and all that,
yeah.
yeah, love that as well.
Yeah, thank you. Yeah, so basically, what happened as we started this business is some of these sponsors that we went out and began to partner with, we realized that, by, really, they've been, and this is exactly what we look for. They've been obsessively focused on finding and operating great deals. They've not been marketers. They've built just a great reputation and really have grown their capital base by referrals and reputation. And as they, see value and expanding out into quote the retail capital world, they needed some help for being introduced to investors that didn't had never heard of them before. They didn't have great quality marketing materials, pitch decks, websites, etc. So we started doing that very high quality, but also wanted to be really doing that for them, but also wanted to be very good stewards of their capitals. So we
Right.
started,
Right.
hiring contract designers from agencies and copywriters, CRM specialists, web developers, et cetera. And then at some point we realized, oh, we have a business here. Jimmy, my co-founder, is an incredible growth marketer. I have the capital raising experience. And so we effectively turn that into a supplemental business where when we have sponsors that we like and we think they've got a great business, but they're just not, they just don't quite check our boxes on the platform. We say, hey, we'll build you a capital raising machine, do full stack marketing, sales ops, back office support, everything we're doing on our side of things. And you kind of get the benefit of our knowledge and expertise, processes and systems. Um, and that's the agency in short.
Awesome. Well,
Yeah.
cool.
Yeah.
Well, awesome. So if anyone wants to get a hold of you, what's the best way to do that, or any other resources you want to mention?
Yeah, thank you. Probably LinkedIn is the best. That's where I'm the most active, or they can go to
Mhm.
equitycheck.com. Either one of those. Andrew at equitycheck.com is my email. My LinkedIn, Andrew James Davis, Equity Check, and then our website, equitycheck.com would probably be
That's
the best ways to connect.
it's a great domain, by the way. How long have you had that for a while?
I bought .co, and then I think I bought the .com in August. And
Oh, wow.
so far that's been a 2.5x. I just checked. I was curious what the value was the other day, and it's about two
Yeah,
and a half
yeah.
x what I paid for it. So
Okay, good. Yeah, I was
good domain investment.
there you go. Yeah,
Yeah,
that's a good one. So, well, cool. Well, appreciate your time. Great to connect again. And yeah, hope you have a great day, Andrew. Good seeing
yeah,
you,
you
bud.
too. Thank you so much for having me.
All
Thanks,
right.
Dustin.